Imagine a 6-year-old boy. He walks into his grandfather's grocery store and buys a 6-pack of Coke for 25 cents. Then he walks door to door in his neighborhood and sells each bottle for a nickel. He makes a 5-cent profit on every pack. That boy was Warren Buffett. He was hustling before he could even drive a car. Fast forward to today, he is worth over $100 billion. He is one of the richest men to ever walk the earth. But here's the crazy part. He still lives in the same house he bought in the 50s. He does not act like a typical billionaire. People think he has a crystal ball or some secret insider information. But he does not. He simply follows a set of rules that have not changed in 80 years. It is not magic. It is just logic, and the best part is that you can copy exactly what he does. I simplified Warren Buffett's strategy, so you can copy him. Let us start with the big idea. It is called value investing. This sounds fancy, but it is actually really simple. Think about when you go grocery shopping. If you see your favorite steak on sale for half price, do you run away screaming? No, you get excited. You buy more of it because you are getting a great deal. But in the stock market, people do the opposite. When prices go down, people get scared and sell. Buffett thinks this is silly. He looks for stocks that are on sale. He wants to buy a dollar bill for 50 cents. This leads us to his most famous quote: "Price is what you pay. Value is what you get." If you buy a brand new car, the price might be $30,000. But as soon as you drive it off the lot, the value drops. Buffett looks for companies where the value is higher than the price tag. He ignores the hype and looks at what the business is actually worth. That is the secret sauce. Now we get into the specific rules. The first one is what Buffett calls the circle of competence. This basically means you should stick to what you know. Imagine a circle. Inside the circle are things you understand perfectly. Outside the circle are things you do not understand at all. Buffett says the size of the circle does not matter. It only matters that you stay inside it. For a long time, Buffett refused to buy tech stocks. People called him old and out of touch, but he did not care. He admitted he did not understand how tech companies made money in the long run. So he stuck to what he knew. He bought shares in Coca-Cola and insurance companies. He knew people would always drink soda and need insurance. He played his own game. This is a huge lesson for us. Do not buy a stock just because your cousin made money on it. Do not buy crypto just because it is trending on Twitter. If you work in a pharmacy, then maybe look at drug companies. If you are a gamer, then maybe look at gaming studios. Invest in businesses you actually understand. If you cannot explain how they make money to a 10-year-old, then do not buy it. Rule number 2 is about protection. Buffett calls this the economic moat. Imagine a big medieval castle. To keep enemies out, you dig a deep ditch around it and fill it with water. That is a moat. In business, the castle is the company, and the enemies are competitors trying to steal customers. Buffett only buys castles with wide and deep moats. Let us look at Coca-Cola again. That red can is a moat. You can make a soda that tastes exactly like Coke. You can sell it for half the price. But people will still buy the real Coke because they trust the brand. That brand loyalty is a massive moat. It protects their profits from anyone trying to copy them. If a company has no moat, then competitors will destroy it. Think about the fidget spinner craze. Everyone started selling them, and the price dropped to zero. There was no moat, no brand, no secret technology, nothing special. So before you invest, ask yourself a question. What stops someone else from opening a shop across the street and stealing all the customers? If the answer is nothing, then do not invest. Rule number 3 is about safety. It is called the margin of safety. This is the engineer's secret to not dying. Imagine you are building a bridge. You calculate that the heaviest truck crossing it will weigh 10,000 pounds. Do you build the bridge to hold exactly 10,000 pounds? No way. That is dangerous. If the driver had a big lunch, the bridge collapses. You build it to hold 30,000 pounds. That extra strength is what keeps you safe. Buffett uses the same logic for money. He does not like risky bets. If he calculates that a business is worth $100 a share, he never pays $99 for it. That is too close to the edge. If his math is slightly wrong, he loses money. He waits patiently. He sits on his hands until the price drops to $70 or even $60. He wants a massive discount before he spends a dime. This gap between the price you pay and the value you get is your safety net. It protects you from bad luck. It protects you from unpredictable markets. It even protects you from your own stupidity. We all make mistakes. But if you bought that $100 stock for $60, you have a lot of room to be wrong and still make a profit. This rule is the only way to sleep well at night while owning stocks. This rule is about patience. It is the 10-year test. Buffett has a famous saying, if you are not willing to own a stock for 10 years, then do not own it for 10 minutes. This goes against everything you see on social media. Everyone wants to get rich quick. They want to buy a stock today and sell it tomorrow for a profit. Buffett thinks this is gambling, not investing. He wants you to think like an owner, not a renter. Imagine the stock market closed down for 5 years. You could not sell your shares even if you wanted to. Would you panic? Or would you be fine because you know the business is strong? Buffett says you should only buy stocks that you would be happy to hold if the market shut down for a decade. If you bought a farm, you would not look at the price of the land every single day. You would look at the crops. Treat your stocks exactly like that farm. The stock market is a device for transferring money from the impatient to the patient. If you are constantly trading, you are killing your returns. You pay taxes on every gain. You pay fees. You make emotional mistakes. Real wealth is built by sitting still. You pick a great company and you let time do the heavy lifting. You do not interrupt the compounding process unnecessarily. Inactivity is actually a superpower. Rule number 5 is often ignored. Bet on good people. When you buy a stock, you're not just buying a ticker symbol. You are becoming a partner with the people running the company. You are basically hiring the CEO to manage your money. Ask yourself a simple question. Would you lend your life savings to this person? If the answer is no, then run away. You cannot make a good deal with a bad person. It is impossible. You need to trust the captain of the ship. Buffett looks for 3 things in a manager: intelligence, energy, and integrity. But he says integrity is the most important one. If a person is smart and energetic but they are dishonest, they will kill you. A smart and energetic crook will steal your money faster than a dumb one. You want a smart crook working for your competitor, not for you. You need leaders who tell the truth even when the news is bad. You want them to be honest about the numbers. Bad management can sink even the best business. So how do you spot them? Read their annual letters. Do they admit their mistakes, or do they blame the economy? Do they talk about the long term, or just the next quarter? Look for leaders who treat the company money like it is their own hard-earned cash. If the CEO is buying private jets and paying themselves massive bonuses while the stock is crashing, that is a huge red flag. Character counts just as much as the balance sheet. This is the hardest rule to follow. Rule number 6 is ignore the noise. To explain this, Buffett uses a character named Mr. Market. Imagine you have a business partner who is a little bit crazy. Every day he comes to your house and yells a price at you for your share of the business. Some days he is happy and offers you a very high price. Other days he is depressed and offers you a very low price. The business itself has not changed. It is the exact same company as yesterday. Only his mood has changed. Most people let this crazy guy dictate their feelings. If he yells a low number, they get sad and sell. If he yells a high number, they get excited and buy. Buffett says this is foolish. You should look at Mr. Market as a servant, not a master. You exist to take advantage of him. You do not have to listen to him. You can just ignore him. The market is there to serve you prices. It is not there to tell you what stocks are actually worth. You have to do your own homework. When the world is panicking, that is usually the best time to buy. When everyone is greedy, that is the time to be careful. Control your emotions and you will beat the market. Now you might be thinking, this sounds like a lot of work. Reading annual reports and analyzing moats takes time. I have a job. I have a life. Do not worry. Buffett has a solution for you too. He calls it the know-nothing investment. It is the strategy he recommends for 99% of people. Instead of trying to pick the one winner, you just buy the whole haystack. An index fund is a basket of the 500 biggest and best companies in America. Apple, Amazon, Google. They are all in there. When you buy one share of this fund, you own a tiny piece of all of them. You do not have to read reports. You do not have to check stock prices. You just bet on the American economy winning over time. This strategy is so powerful that Buffett actually bet $1 million on it. He bet that a simple index fund would beat a group of fancy hedge fund managers over 10 years. And guess what? He won. The index fund crushed the experts. So if you want to copy Buffett but you do not want to do the homework, just buy the S&P 500. Keep buying it every month and never sell. Investing is not about being a genius. It is about controlling your urges. We covered the moat, the margin of safety, and the index fund. You have the map. Now you just need to start walking. The best time to plant a tree was 20 years ago. The second best time is today. Start small and be consistent. Let compound interest work. In 20 years, you will thank yourself for starting now. I read the boring financial books so you do not have to. If you want to master your money, then hit that subscribe button. I will see you in the next video.